got to be prepared to, when you buy a stock, to have it go down 50% or more and be comfortable with it as long as you're comfortable with the holding. You should not count on somebody else telling you you should do something you understand yourself.
If I were getting out of school today and I had $10,000 to invest, I'd start with the A's. I would start going right through companies, and I probably would focus on smaller companies.
When the conditions are right, it should also be obvious to repurchase shares, and there shouldn't be the slightest taint to it any more than there is to dividends.
Warren Buffett dismisses the hype around economic predictions, emphasizing the insignificance of such forecasts in true wealth creation.
What would you cite as the most important reason for your early success with small amounts of capital? And given hindsight today, what might you have done to improve your strategy with these small funds?
Yeah, well, I had a great teacher. I had exceptional focus, and I had the right sort of emotional qualities that would help me in being an investor. I enjoyed the game. I mean, it's just about, hard enough to be interesting, but not so hard as to be beyond the capabilities of people understanding it. And that's kind of the way this game is. I mean, it's not like Henry Singleton kind of questions he took on. It's actually a pretty easy game, and it does require a certain emotional stability. And I went at it, hammer and tong. I went through the manuals and everything, but I was enjoying when I did it. And like I say, I started out between ages 7 and about 19. I had that same enthusiasm, but I didn't really have any guiding principle. And then I ran into The Intelligent Investor and Ben Graham, and then at that point I was able to take all this energy and everything, enthusiasm for it, and now I had a philosophy that made a lot of sense, total sense, and I found that I could employ, and so the game became even more fun, but it wasn't really more complicated than that.
The key to financial success, according to Buffett, involves a patient approach, either starting young or embracing the longevity of the investment journey.
I don't care about economic predictions on it or anything of the sort. I do care that over the years it's well tended to in terms of rotating crops, and I hope yields get better, which they generally have. In fact, that farm 100 years ago would have probably produced 30 bushels, maybe 35 bushels of corn per acre. And now in a good year, it'd be 200.
Buffett critiques the excessive worry over short-term market fluctuations, highlighting the importance of a broader perspective.
I'm not recommending that people buy stocks today or tomorrow or next week or next month. I think it all depends on your circumstances, but you shouldn't buy stocks unless you expect, in my view, you expect to hold them for a very extended period, and you are prepared financially and psychologically to hold them the same way you would hold a farm and never look at a quote.
Sharing insights into his investment philosophy, Buffett discusses the rationale behind his long-term commitment to Apple.
The big thing about it is we started building this little snowball on top of a very long hill. So we started at a very early age in rolling the snowball down. And of course, the snowball, the nature of compound interest is it behaves like a snowball of sticky snow. And the trick is to have a very long hill, which means either starting very young or living to be very old.
Investors, Buffett suggests, should view stocks as ownership in businesses, emphasizing the significance of acquiring them at favorable prices.
I mean, we've really made progress in this country. That's one reason commodity prices, if you go back a couple hundred years, they've moved so little, is because we've just gotten better and better at whether it's cotton or whether it's corn or soybeans or all kinds of things. And you and I have benefited from that.
Buffett delves into the various strategies Berkshire employs to distribute cash to its shareholders for sustainable and ethical wealth growth.
If you're going to look at the price of the stock and think that you have to act because it's doing this or that, or somebody else tells you, well, how can you stay with that when something else is going up or anything? You've got to be in the right psychological position. And frankly, some people are not really careful. Some people are more subject to fear than others.
Exploring Berkshire's buyback strategy, Buffett sheds light on the company's approach to repurchasing shares when conditions are opportune.
I would do it exactly the same way if I were doing it in the investment world. If I were getting out of school today and I had $10,000 to invest, I'd start with the A's. I would start going right through companies, and I probably would focus on smaller companies because I would be working with smaller sums, and there's more chance that something is overlooked in that arena.
The Oracle of Omaha encourages independent thinking, asserting that self-reliance is the key to uncovering valuable investment opportunities.
If you buy a business, if you buy a farm, you go up and look, every couple of weeks to see how far the corn is up, and you worry too much about whether somebody says this is going to be a year of low prices because exports are being affected or anything like that. You buy a farm and you hold it for. I've got one farm that I bought in the 1980s, and my son runs it, but I've been there once. It doesn't grow faster if I go and stare at it. I can't cheer for it. More effort, or something like that. And I know there's going to be some years when prices are going to be good and some when the prices aren't going to be good. I know there's years when yields will be better than others.
Discussing capital distribution, Buffett reveals how Berkshire strategically allocates capital, ensuring it aligns with long-term growth objectives.
You don't need to pay attention to them. The main thing to do, and you're not going to pick the bottom, and nobody else can pick it for you or anything of the sort. You've got to be prepared to, when you buy a stock, to have it go down 50% or more and be comfortable with it as long as you're comfortable with the holding. And I pointed out, I think a year, maybe 2 years ago in the annual report, just the one before this most recent one, I pointed out that there have been 3 times in Berkshire's history when the price of Berkshire stock went down 50%. 3 different times. Now, if you owed it on borrowed money, you could have been cleaned out. There wasn't anything wrong with Berkshire when those 3 times occurred.
Buffett underscores the legitimacy of stock repurchases, equating them with dividends, asserting their role in enhancing shareholder value when conditions are favorable.
And so Apple is kind of like a farm.
Well, it's a long-term investment, and if you own the best auto dealership in town, the best brand, and had somebody good running it, you wouldn't drop by every day and say, how many people have come in today, or, I think interest rates are going up a little, maybe it'll slow down our sales or anything. No, you buy it knowing there's 365 days a year, and you're going to own it for 20 years, so that's 7,300 days, and things are going to be different from day to day and year to year. You shouldn't buy it if the day-to-day stuff is important. It's like the virus. It strikes some people with much greater ferocity than others, and fear is something I really never felt financially, but I don't think Charlie's felt it either. But some people can handle it psychologically. If you can't handle it psychologically, then you really shouldn't own stocks because you're going to buy and sell them at the wrong time. And you should not count on somebody else telling you you should do something you understand yourself. If you don't understand it yourself, you're going to be affected by the next person you talk to. And so you should be in a position to hold. And I don't know whether today is a great day to buy stocks. I know it will work out over 20 or 30 years. I don't know whether it'll work out over 2 years at all. I have no idea whether you'll be ahead or behind on a stock you buy on Monday morning or the market.
And as Charlie has said earlier, it won't be like doing that in 1951 when you could leaf through and find all kinds of things that just leapt off the page at you. But that's the only way to do it. You have to buy businesses or little pieces of businesses called stocks, and you have to buy them at attractive prices, and you have to buy them, and you have to buy into good businesses. And that advice will be the same 100 years from now in terms of investing. That's what it's all about. And you can't expect anybody else to do it for you. People will not tell you about wonderful little investments. It's not the way the investment business is set up.
There's a lot of crazy things said on buybacks. Buybacks are so simple. I mean, it's a way of distributing cash to shareholders. And let's just say that you and I and Greg, the three of us, decide to buy an auto dealership or a McDonald's franchise or something, and we each put $1 million in, or whatever the number may be. And we get along with each other and the business grows and all of that. And one of us really wants to spend our share of the earnings. And the other two want to leave the money in the business to grow. Now, if the three of us did that, and we're the only shareholders, we would not establish a 100% dividend payout for everybody, and we wouldn't freeze the one that wanted to get out either. The logical thing to do is to buy a portion, whatever that person wants to spend annually from the earnings, buy a portion of their stock, and the other two find their interest in the company goes up. And the third person still has a little more of an interest by what they leave in, but they also can take some money out of the business. So you're taking money out of the business in either case, and one you call dividends and you send it to everybody whether they want it or not. And with buybacks, you give it to the ones who want the money. We will buy Berkshire when we have lots of excess cash. All the needs of the business are taken care of. We spent $14 billion on property, plant, and equipment last year, way more than depreciation. So we take care of the needs of the business. Then we have excess cash. And if we find we'd love to do is find other businesses to buy. But if I think the stock, and my partner Charlie Munger think the stock is selling below intrinsic business value, we will buy in stock.
So it obviously was at that point.
Well, we thought so, yeah. But what's really intriguing is when it goes down a lot. I mean, when you're buying dollar bills for 60 or 70 cents, which periodically you get a chance to do in stocks, then assuming you've got the cash, you don't want to ever, get so that some surprise could really take you out in some way. But if we've got excess cash, we'll buy it as fast as we can.
But at that point, it would be more like a 2009 rather than just December of this past
year. Exactly.
Right.
But it's, if you and I own a McDonald's franchise together and it's worth $1 million and you own 50% of it and you come to me and you say, I'll sell out for $400,000, I'll buy you out. When I first visited Geico in January of 1951, and that rest of that year, I subsequently went down to Blythe and Company, and actually to one other firm that was a leading Geyer and Company, that was a leading analyst in insurance. And I thought I'd discovered this wonderful thing, and I'd see what these great investment houses that specialized in insurance stocks said, and they said I didn't know what I was talking about. It wasn't of any interest to them. You've got to follow your own, you've got to learn what you know and what you don't know, and within the arena of what you know, you have to pursue it very vigorously and act on it when you find it. And you can't look around for people to agree with you. You can't look around for people to even know what you're talking about. You have to think for yourself. And if you do, you'll find things. I have been following a policy of giving away stock now since 2006, and I'll give away a lot of stock, but the people, the philanthropies that receive it, the gifts have to spend the money very promptly within, on a current basis, more or less. So they are getting $3 billion worth of stock or whatever it may be, and I'm in effect reducing my interest in Berkshire, but Berkshire's still retaining more capital than I'm giving away. So I have more dollars invested, but my interest goes down. And the people that need the cash to carry out the philanthropic efforts, they cash out the stock. And I don't force my sister or whoever it may be to take a bunch of money she doesn't want. She wants it reinvested, all of it reinvested in the business. And people that
don't want to can sell some of their stock, and the company ends up in the same position. We've distributed some of the capital that we don't need for growth. Now, whether the company should buy it depends on a couple of things. One is they ought to retain the money they need for intelligent growth prospects. That's fine. And secondly, and this is a point that's never mentioned, they should be buying it back below what they think it's worth. Now, they'll make mistakes in that, but you make mistakes in a lot of business decisions, but that should be the guiding principle.
When you're dealing with something like Coke is raw numbers. I mean, there's huge potential in a country, with the largest country in the world, in China, where the per capita consumption is very low, but is growing very fast. So it's very easy for me to predict and probably be right, absent some tremendous upheaval or some real surprise, that China would be the fastest growth market among countries of any size in the world for Coke from this level. But that's based on the fact that you just got a huge number of people that clearly like the product, that are starting from a very low base, and where a lot more bottling infrastructure is going to be needed, but which will be supplied to facilitate that growth. With Gillette, it's a little different. And people are already shaving. What you do is you upgrade the shaving experience that they have.
J.P. Morgan, Jamie Dimon said it once, and we've said it various times. We retain, we will repurchase shares when it's to the advantage of the continuing shareholder to have us do so. But you read about all these buyback programs that we're going to spend $5 billion buying it back, or $10 billion. Well, that's like saying I'm going to go out and buy some business this year for $5 billion without knowing what you're going to get for the money. It should be price sensitive, obviously. It should be needs sensitive, obviously. But when the conditions are right, it should also be obvious to repurchase shares, and there shouldn't be the slightest taint to it any more than there is to dividends. And people that have now sort of taken up the cries about how terrible it was that companies bought back stock. Well, you can say it was terrible for them to pay dividends too, then they'd have more money now. But they were doing what was intelligent at the time, and I hope they continue to do what's intelligent as they go forth.